Hi, I'm Brian Beaulieu from ITR Economics. Thank you for joining us for this edition of FedWatch. Today is May 5th, 2023. On Wednesday, the FOMC announced that they're going to put up the Fed funds rate. They have put up the Fed funds rate, another 25 basis points. So now it's trading between 5 and 5.25 is where it's running. And that's the bad news. In our opinion is, they didn't need to do that. The disinflationary trends were clearly marked. We've seen the quit rate go down, all the rest of it, but they did it anyway, so it is what it is. The good news is they've changed the language to suggest that they're not going to be as likely to put through another rate increase in June as they had previously signaled, and that's good news. They can stop. And they're saying that they're going to be looking at how things are going, and that's language similar to what we've seen before when they're really serious about, okay, maybe we've done this enough. Certainly with the banking issues, they have cause for doing that. What's this mean to our forecast? Nothing. We expected 25 this month. We had built in, if they needed to, another 25 next month, and it wouldn't change our forecast at all. So the next big hurdle is not whether they're going to raise interest rates. Really, from our perspective, it's will they start lowering interest rates by the end of the year? And they could. This pause means that they could go in that direction, and that will help our 2025 recovery program. Just a word about the First Republic Bank failure. It wasn't a surprise. It has been in the news for quite some time. They shared something with the other failed banks, and that's really high levels of deposits that were not covered by FDIC insurance, besides getting hit with the investment portfolio woes that comes with high interest rates. JP Morgan's a good match for them. And the final thing I wanted to mention is that commercial industrial loan charge-offs remain very low, which is very important right now. It's one of those symptoms of a bad recession is when they go really high, and right now they are in very good shape. The commercial mortgage part of that portfolio is showing some distress. That's the highest distress level in about 14 years, and it's at 5.2%. Fortunately, commercial real estate mortgages only make up about 15% of the entire commercial and industrial loan space. So you're not looking at some potential massive contagion, at least not yet. Read this month's executive summary in the ITR Trends Report. We go into some of the pressure points going on in the commercial real estate market, particularly for office buildings. And we're taking a look also at the price declines that are occurring in commercial real estate in general, much more pronounced in office buildings, and a little bit back on multifamily real estate, although multifamily real estate is still running 5.2% ahead of where we were 1 year ago. So all told, there's more good news than bad news. Fed's likely to take a pause. First Republic is nestled in with a stronger bank, and the default charge-off rates remain very, very low. So could be a lot worse, folks. Thanks for joining us for this edition of FedWatch.